Hello and welcome to NavTalk. NavTalk is proudly brought to you by the Navwealth Financial Group, helping you reach your destination in life on purpose. My name is Simon Prowse and I'll be your regular host for this series of podcasts. And I look forward to bringing you interviews and content on a broad range of topics. Topics that will be educational, inspirational, informative and at times fun. Welcome to NavTalk and the second of our two-part series on structuring your business, more specifically for success. As with part one, I'm here today with the host of the show, who I'll hand over the reins in a second, Hayley Kalms. Hi, Hayley.
Hi, Simon. How you going?
I'm good. And once again, you're probably looking forward to take over the reins for this chat.
I'm always looking forward to that. So part two, Simon, we are going to talk about actually selling your business. So part one, we talked about structuring your business correctly for success. Now we need to ensure that that is also the perfect setup for selling your business and getting the best value back for your business and for all your hard work, really.
Yeah, absolutely. So this is the sell part, if you like, and we've done the hard part, which is getting it set up and building it. Now let's get out of it with what we can and we'll maximise our returns.
Yeah, I find a lot of small business don't plan for that succession planning part of the business. They just, they don't think about that. They're just happy to work away for most of their working life and then get up and lead their small business. And they've put so much time and investment in that. They should really get a return on that.
Yeah, it seems a bit crazy. You wouldn't get up and leave your house and just shut the door and say goodbye. We see it all the time with businesses. And really, it is about just that planning stage. And if you don't know, get people in to help you. But because it's such a big deal when it comes to the outcomes that can be achieved and the differences between a good outcome and a bad outcome.
Yeah. So how can we help businesses succeed in selling their business?
Okay, well, let's get into it.
Right, so we've set up the structure, we've started trading, we're doing business, and then we decide it's time to sell my business. How do we go about that?
Well, the first thing is, when it comes to selling a business, it's something that I think personally, and I did touch on this with my talk with Peter Hickey, is that you don't just decide to sell tomorrow. It's planning to sell. Yep. So it could be a fairly lengthy process, and what I mean by that is some years. For example, if you haven't quite got your structure right and you need to sort your affairs out, and what I mean by that is potentially change your structure or do something, you could find that by doing that, you need to actually wait 12 months in order to get the advantage of some tax concessions. Yeah. And I'll talk about those a bit later, but you should, in my opinion, be thinking a long way out from selling and getting it right.
Yeah, that's the common thing with small business. People don't think about succession, or they think, oh yeah, I run my business and that's it, I retire. And then what's the value in your investment then, in all your hard work? You're not just going to give it up. You want it set up correctly to get the best value out of it. Yeah,
if you like, and this is going to the extreme, you should be performing what they call a reverse due diligence. So if you're going to be buying a business, you're going to do a due diligence. That means you're kicking the tyres and making sure everything's in its proper order and right. Mm-hmm. If you're the business owner and you do what's called a reverse due diligence, you're A, going to have everything you need to sell it, and B, you've already identified all the things that could put a sundry to that selling opportunity. Because when you go to the market, and if you're not ready, guess what? The market's going to bring you down and challenge your price.
Yep. It's like selling a house.
Absolutely. Dress it up.
Dress it up and get the best price. Yeah.
Absolutely. So just a word of warning, everything we're going to talk about now is extremely complex, okay? It is not, oh, well, these are the 4 rules and, if I tick the boxes, I'm going to be fine. You need to look at the fine print around all these exemptions, and if you trip over, you can trip over badly. And I've seen lots of examples over the years where people have thought they could achieve this outcome and they haven't quite got their house in order. So it's really important to seek advice on this and tread your way through it carefully.
Yep. So those words of warning, what are we looking at?
Okay. So in terms of the concessions, maybe I'll jump into the concessions and then we'll understand the pitfalls and traps of it all. So essentially, in the world of capital, if you like, so we're talking about brokering an asset or buying and selling of a business, which is made up of, well, assets, tangible, we can touch them, and intangible, goodwill. We can't touch it, but it's there. Things like client lists and so forth. Anyway, we're contemplating selling assets. And in that process, there's a number of exemptions within the tax system that allow for assets to be sold and the tax treatment is discounted. So the first is if you've held an asset for 12 months or greater. And if you do that, effectively half the gain, capital gain it's called, gain you make on the sale of that asset is discounted. In other words, it's not taxed, it's free. So that's just general CGT discount, and we get that on buying and selling of shares, property, you name it. That's the primary discount. Now, the only rule around that discount is you've got to hold that asset for greater than 12 months. So in my example before, if you decide that you want to sell your business and you realise that your assets aren't quite in the right spot and not going to avail you of a discount and you move them, you've probably got to hold them for 12 months in that vehicle or that environment to get that discount, because you trigger any changes triggers the starting of that clock.
Right. So that's going back to planning and your succession planning, making sure you've got plenty of time to set yourself up to sell your business.
Absolutely. And then we get into the other business discounts. And these are quite spectacular if you get them right, and can obviously hurt if you don't. Now, I'm going to warranty that in terms of these discounts are only available if two specific criteria are met. And there's one other criteria to do with active assets, but I'll talk about that in a second. And the two specific criteria around how much you've got. So that is $2 million turnover test. So you've got to be a small business. So if your business is turning over $2 million or less, you can qualify as a small business. And then there's or your net value of your business assets is $6 million or less. Now, it's not just your business assets, it's your assets. Okay. And I've got to be careful too when we say that, because your assets are anything that you own outside of your family home or your super fund and personal use assets. So your super fund can be whatever value you want, your home can be whatever value you want, personal use assets being boats, cars, things like that, aren't calculated in this 6 million test. However, those of your business associates, spouse, other partners, potentially could be. So we need to be very careful of that. So there's one of those ones where we could trip over.
Yep.
For example, if you're over the 6 million and you do some planning, you could opt to divest yourself of an asset or two, or put some money into super, or pay off your house mortgage. That would bring your net asset value down outside of the house and super to under 6 million. So again, planning. That 6 million is pretty critical.
Yep. Would never have known that without some advice.
There you go. And that's why you've come to see me.
Exactly.
Okay, so assuming we've met these two tests, either or, and assuming we've got an active business asset. Now, what an active business asset is one that we're actually working in. So if you've got a rental property and you're sitting back waiting for the tenant to pay your rent, that's not an active business. If you're out there providing services, selling goods, and you're involved in the business and you're running it, that's an active business. Okay? So really important, passive versus active. So it's your active business asset. There must be an active business asset. In the $6 million test, the passive business assets or outside of business assets are captured. However, we've got to have an active asset that we're selling. Okay? So they're the fundamentals. Again, we're touching on the fundamentals. There's a lot of grey in these exemptions or the rules that we're talking. But generally speaking, active business asset, $2 million test, $2 million turnover, $6 million net assets. From there's 4 specific exemptions. So we talked to the general CGT discount. That's for everyone. This is the specific small business exemptions. And they are the 15-year exemption, firstly. So the 15-year exemption says if you've been running your business for 15 years and you've been involved with it and owned it, so how have you owned it? you can actually pay no capital gains tax on the sale of that asset. That's it.
Wow.
No passing go, that's it.
Yep.
So you've met those criteria we talked about, active, small business, 2 million, 6 million. You can sell your business and pay not a cent of tax. Awesome.
Nice.
Right, that's it. Get out of jail, go on a holiday, one
Enjoy
lotto.
your retirement.
If you don't meet the 15-year exemption, there's some other exemptions that you can trigger. And the first is a general 50% active asset reduction. So we re-identified the active asset. We've sold a business, and I'll give you an example. We've sold a business for $100,000. We've created the 50% discount because of the general discount. Well, we get another 50% due to the active business assets. So effectively, we're down to 25% of that gain being taxed. All right? And there's no other rules around that active asset other than it's active, and you've met those 3 criteria. Then there's the retirement exemption, okay? And the retirement exemption says, effectively, if we take the capital gain at whatever level, after whatever exemption we impose, and it can be after the 50% reduction, the 50% active asset reduction, and we take that money and we put it into superannuation under what's called the retirement exemption, then we can effectively mitigate the entire tax liability. Now, when I say the entire tax liability, this is again subject to limits. Essentially, you've got a $500,000 retirement exemption limit for rolling into super. So you essentially, if you've got $750,000 left after you've applied exemptions to be taxed, you can only put 500 into super. So you'd be left with an amount of money that would be taxed effectively. But if you work backwards, it's a fairly big lump, because if you say 500 can go into super, that means if I trigger the active asset exemption above that, that's $1 million. And if I trigger the general CGT discount, that's $2 million. So we're starting to get a fairly big number that we can effectively get and pay no tax on. Yep. And that's per person.
Yeah, right.
Okay.
That's a big, yeah.
Now, the final exemption in this whole program is, in the whole lot of small business exemptions, is the small business rollover. So what the ATO has said is, all right, well, if you're going to sell your business and have a gain, again, we can use all these exemptions we've talked about. And if there's a small amount that's left, we can potentially utilise this another 2-year exemption, or another exemption that applies for 2 years, that says if we go and buy another active business or invest in a business or buy it, essentially, we can roll that money or use that money to apply to that asset. So essentially, we're getting rollover. We don't pay any tax if we go and buy another asset. However, the cost base of that asset is adjusted by that rollover amount. So let's say we buy a business worth $1 million and we had $250,000 that we rolled over for that 2-year period. The cost base of that new asset is $750,000, not the $1 million. So it comes off the cost base of the new asset.
So it sounds like a very sort of complicated topic there, Simon. Definitely need something on advice on, and to get the business to understand all the different exemptions and possible tax benefits that you can get. Is there just a brief example that you can give us that shows us the benefit of good planning and getting the best tax result?
I think you nailed it there, Hayley. The planning part is fundamental. If you don't, it could just smash you in terms of the tax man. And I've got I'll cover an example as best I can without getting into too much detail. And more importantly, if someone wants to understand this better, I'd encourage them to give me a call, and I'm more than happy to share some information we've got around it. But as an example, and it's very high level, we've got a business worth 6.4 million. Sorry, got a business with its net assets and associate assets of this business owner and his spouse at $6.4 million. And we've agreed to sell, right? Or we're planning to sell. Now, in this case, the tax on that 6.4 million ranges from the ultimate tax we're paying to the taxman, ranges from $720,000 on that sale to zero. Yep. So it's massive, massive. So with some planning, and I'll try and go high level really quickly through this. We've got $6.4 million in net assets. So we're over the asset test.
Yep.
So what do we do? Well, this person happens to have a mortgage on their house. So we go pay off the mortgage. So immediately we brought assets down, because remember the house is exempt. We brought the assets down by the amount that we pay off the mortgage, because the mortgage is exempt being the assets because it's attached to the property. We then say, okay, well, why don't we put some money into super? And putting money into super can go in two forms. It can go in as a concessional or a non-concessional contribution. So you can, between husband and wife, and if you've never used super before, you can get quite a lot of money into super using certain bring forward rules and the like. So let's just say we've brought that 6.4 million down from 6.4 million to 5.8. So within the a bit of planning, within sort of two transactions or two planning steps, we brought it down to 5.8. We then say, okay, what's the structure look like to get the 5.8 out to the shareholder in the most efficient manner? And that might be that, well, we're 1 year off the 15-year exemption. Don't sell the business till next year. It might be that we need to make sure we've got enough cash flow because we've got to pay super. We've got to put some money into super. Well, let's plan to make sure we've got realise enough cash from this transaction to roll it into super in certain timeframes so we don't pay any tax. And by the way, when we roll that money under the retirement exemption into super, it's not taxed in super. It's just parking it until you reach your age where you can actually access it. So it's effectively your money still. It's just pushing it to an area where you can't touch it until you've reached certain exemptions.
That's a whole another topic. That can be whole another podcast on
exactly. But in short, in this, my very high level at $6.4, $720,000 tax on the ultimate outcome, down to potentially zero tax with some planning. So it's fundamental. Like if you don't get advice on this, you're crazy.
Definitely. Yep. And people aren't educated on this. They have no idea when they're going into business that they should be doing this.
Yeah, it's definitely a specialist area. I mean, I covered it early. Get the foundations right that allow you to do this. Plan to get out, plan early, but more particularly if your foundations aren't right, you could fall over with the tax exemptions. And in saying that, if your foundations aren't right, get them right, but just make sure that in getting them right, you know that you've got certain obligations you've got to meet in order to later sell your business, and don't do it before you've got it right, so to speak.
Yep.
Planning.
It's all about planning. Well, thanks, Simon, for those takeaways today. It's been really interesting to see. We sort of went through a whole lifespan of a business, really, and what we should do. So it's really interesting to know that you should be planning from when you're starting your business to ending your business. It seems like a weird concept to plan for ending when you're just starting, but it is so important to get that structure right at the start, and to sit down with your professionals and your accounting team, get that structure and that setup correct, so that when you do sell, you're getting the best tax-wise and happy retirement, really. Have I summed it up right?
Absolutely, Hayley. And yeah, look, planning and seek advice are the two big ones for me.
Yeah. Thank you, Simon. That was fantastic.
Thank you, Hayley. And thank you for being the interviewer today. It's sort of been a bit different for me, but I hope everyone got a bit out of it, and I hope my dulcet tones didn't send anyone to sleep. Thanks for joining us today for NavTalk. You can listen to other podcasts in the NavTalk series via YouTube or where you get your favourite podcasts, or simply search NavTalk. Be sure to follow Navwealth on LinkedIn, Instagram, Facebook or Twitter. And please, if there are any particular topics you would like us to cover for a future episode, let us know via our website. I'm Simon Prowse. Until we talk again.